the key point is that if you take the US market, 40% of buyers in the market don't really pay attention to risk and return criteria. What they're doing is they're buying for reasons of regulation or prudence, or because they have to match liabilities or duration or whatever it may be. Risk and return don't really come into that equation. And you can see that very clearly with what happened in the UK gilt market. And many people speak about the sort of the death of the 60-40 investment model. In other words, holding 60% in stocks and 40% in bonds. The reality was that model died many years ago. And what you were in practice looking at was a model that was in fact started off with 80% in equity and 20% in fixed income. But because of regulation, the 20% in fixed income was leveraged about 5 times, okay, through derivatives. And that's what a lot of pension funds were doing. And what's more, they may have taken 20% out of the 80% equity pot and put that into a liquid assets like private equity. And so when you started to get dislocations in the fixed income markets, particularly in the UK gilt market, the whole thing unraveled very fast, and you got this huge illiquidity hit. And consequently, what was happening was, because you've got margin calls on the derivatives, a lot of these funds were being forced to sell the only liquid assets they had, which bizarrely were government bonds. And so the whole thing basically ballooned out. You got this vicious circle of rising yields, and the Bank of England had to step in. Now, that's partly market events, but it's also the technicalities of how these things operate. The problem is, the fundamental problem that world financial markets have is there is a structural shortage of safe assets in the system. And basically, a lot of funds have to leverage those. And that's what's causing the problem. I mean, just look. I mean, I've said before on my occasions on Real Vision, it's wonkish to think in these terms, but start looking at the term premium in government bond markets. The textbooks tell you that term premium, which is what you would normally get as a reward as an investor for holding interest rate risk, is now something you've got to pay to the market. You've got to pay to take interest rate risk. So the further out on the curve you go, in other words, moving from 1 year to 10-year treasuries, you basically have to pay a premium to the market to hold longer dated debt. Now that's not in the textbooks. They say that can't happen, but it's happening, and it's been happening for years. And what that's telling us is there's a structural shortage of these instruments in the system, and that is not good. If you've got such big negative numbers in terms of negative term premium, it's telling you there's something very, very badly wrong.